Here's a problem nobody put on a keynote slide. An AI chip is basically a tiny, ferociously expensive space heater. Pack a rack full of them, and, without serious help, they'll cook themselves. So before any of that AI magic happens, two deeply unglamorous things have to work: clean power going in, and a way to haul the heat back out. Vertiv sells both. I'm Onyx.
And I'm Nova. Welcome back to the Working Thesis. Ticker VRT. If Own the Inputs has a poster child in the physical world, it might be this one. Quick framing as always. This is a company explainer, not a recommendation. Let's understand the business, the bull case, and the bear case.
First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud, personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. The why now is pure physics. Older data center racks drew maybe 10 or 20 kilowatts, and you could cool them with air. The new AI racks, the NVIDIA Blackwell class systems, can pull well over 100 kilowatts each. Individual chips are pushing toward 1,000 watts apiece.
At those densities, blowing cold air just doesn't cut it anymore. You physically have to bring liquid to the chips. That single shift from air to liquid is the growth engine of this whole company, and it's why a once sleepy infrastructure name suddenly sits right in the middle of the AI story. Snapshot. Vertiv is headquartered in Westerville, Ohio, with around 34,000 employees. It sells the physical layer of the data center, power gear, cooling gear, and the services to keep it all running. In 2026, roughly 78% of its business is data center, and the Americas are its biggest region.
The 2026 guide from our research desk: revenue around $13.5 to $14 billion, growing roughly 30% organically, with adjusted earnings per share in the low $6 range. Market value is up around $130+ billion. So this is a large, fast-growing industrial, not a startup, but suddenly growing like one. The history here is a genuinely great turnaround tale. Vertiv used to be Emerson Network Power, a division inside the industrial giant Emerson Electric. In 2016, Emerson sold it to a private equity firm, Platinum Equity, for about $4 billion, and it was rebranded Vertiv.
Then in 2020 it went public through a SPAC, a deal led by the legendary former Honeywell CEO, David Cote. And that's the key to the story. Cote brought the Honeywell operating playbook, relentless margin discipline, to what had been a lower-margin corporate orphan. Under that playbook, plus the AI demand wave, Vertiv transformed into a high-growth compounder. By early 2026, adjusted operating margin had jumped to around 21%, with operating profit up more than 60% year over year. That's a different company than the one Emerson sold. Let's walk the product line, because Vertiv basically sells everything that sits between the power grid and the GPU. On the power side, the grid interface, switchgear, uninterruptible power supplies, the UPS systems that keep everything alive through a blip, plus busways, power distribution units, and batteries.
On the thermal side, traditional precision air cooling, chilled water systems, and, increasingly, the liquid cooling gear. And then integrated modular systems, controls, and a big services arm for design, deployment, and lifecycle maintenance. The strategic point is that as racks get denser, integrating power plus cooling plus controls plus service matters far more than any single box. And that integration is exactly what Vertiv sells. Let's actually explain liquid cooling, because it's the heart of the growth story. There are a few flavors. Direct-to-chip is the main one. You mount cold plates right on top of the hot chips and pump liquid coolant through them, pulling heat away at the source.
The unsung hero is a box called the CDU, the Coolant Distribution Unit. It sits at the row or pod level and acts as the middleman. It pumps and filters the coolant, controls its temperature, watches for leaks, and keeps the server's liquid loop separate from the building's water loop. Then there are rear door heat exchangers, radiator-like doors on the back of the rack that grab leftover heat from the exhaust air, and at the extreme, immersion cooling, where you literally submerge the servers in a non-conductive fluid. Air cooling tops out around 20 kilowatts a rack. These liquid methods can handle 100 or more. That's the gap Vertiv is selling into. And here's the validation moat. Vertiv co-developed an end-to-end power and cooling reference architecture with NVIDIA for the GB200 NVL72 platform. The dense Blackwell systems, designed for racks up to 132 kilowatts and scalable to 7 megawatt data center blocks.
Why does that matter so much? Because when NVIDIA effectively publishes a blueprint that says here's how to power and cool our flagship AI system, and Vertiv's gear is in that blueprint, Vertiv becomes a default choice for anyone deploying it. It's a hybrid liquid and air design, built to minimize wasted stranded power and to deploy fast, and speed, when AI capacity is supply constrained, is its own competitive edge. That co-design relationship is hard for a competitor to replicate quickly. On leadership, David Cote remains the executive chairman, the operating discipline architect. The CEO, Giordano Albertazzi, is a longtime Vertiv operator who's run the company through this AI demand surge. And the CFO, Craig Chamberlain, joined in late 2025 from senior finance roles at Wabtec and GE, heavy operational finance and integration experience.
The through line is industrial operating pedigree, and it shows up in the numbers. That margin expansion is the proof. The risk, and we'll come back to it, is that the stock now embeds near flawless execution. When you've delivered this well, the bar for good enough keeps rising. Competitively, Vertiv plays against some heavyweights. Schneider Electric is the biggest and broadest data center electrical peer. Eaton is strong across power infrastructure. ABB and nVent are in the mix too. And on the cooling side, there's a whole pack of thermal specialists.
Where Vertiv leads is high-density and precision cooling, especially liquid, plus those integrated power and thermal reference designs, and a service-led approach to hyperscale deployment. Where it trails, Schneider, Eaton, and ABB have broader electrical footprints and bigger balance sheets. So Vertiv isn't unchallenged. Its edge is being the most focused and arguably the best integrated on the precise problem AI created: cooling absurdly dense racks. Who buys it? The demand base is hyperscale cloud, the neoclouds, colocation providers, big enterprises, and telecom. And here's a genuinely reassuring detail. According to its filings, no single customer is even 10% of sales. That's far better diversification than, say, the neoclouds we've looked at.
But, and this is the crucial nuance, even with no single dominant customer, Vertiv is fundamentally a supplier to the spenders. The group of hyperscalers and colo operators that drives its orders is the same group pouring capital into AI. So Vertiv's fortunes ride on hyperscaler capital spending staying strong, even if no one client can sink it alone. That dependency is the thing to keep in the back of your mind. The demand signals here are honestly extraordinary. Late in 2025, backlog was around $15 billion, up more than 100% year over year. The book-to-bill ratio, new orders versus current sales, was something like 2.9, meaning orders are coming in almost 3 times faster than revenue is going out. Organic orders at one point were up over 250%.
And the structural runway is the liquid cooling ramp. Third-party studies see that market growing from a few $1 billion in 2026 toward the mid-20 billions by the early 2030s. A multi-year secular wave where Vertiv is a clear leader. Add operating leverage as volume scales, and you get the high-growth, expanding margin profile that's made this stock a favorite. The job now is converting that giant backlog cleanly. So the risks. Number 1, and it's the big one: hyperscaler capex concentration. Vertiv supplies the spenders, so if hyperscaler spending slows, defers, or shifts architecture, suppliers like Vertiv can re-rate sharply and fast. That's the central dependency of the whole picks and shovels trade.
2. Expectations. The valuation already prices exceptional growth, which we'll get to. 3. Backlog conversion risk. $15 billion has to turn into revenue without supply bottlenecks or margin leakage. For competition, Schneider, Eaton, and ABB are chasing the same AI dollars, and pricing pressure can build as capacity expands. 5. Supply chain and tariffs on all those electrical and cooling components. And 6. Technology risk. The liquid cooling world is still settling on standards, so today's preferred design could shift. Valuation is the crux of the bear case, so let's be clear-eyed. The trailing price to earnings is up in the high 80s. The forward multiple is somewhere around 50+ times. Enterprise value to earnings is in the mid-50s. For context, that valuation has expanded enormously, from high teens just a couple of years ago. The stock price is in a sustained AI capex supercycle, durable liquid cooling leadership, high backlog conversion, and fat margins, more or less all going right.
But here's the important contrast with a name like CoreWeave. Vertiv is genuinely profitable, with low leverage and real free cash flow. So the risk here isn't solvency or a debt spiral, it's simpler and subtler. At these multiples, even a good result can disappoint if growth merely decelerates. The danger isn't that the business breaks. It's that the business stays strong and the stock still derates because perfection was already in the price. That's a very different kind of risk, and worth understanding precisely. The two cases. Bull, Vertiv is the best-positioned picks and shovels supplier to AI data centers. The full power plus cooling plus services stack, validated by that NVIDIA reference architecture, with a $15 billion backlog, rising margins, and strong cash flow. If rack density keeps climbing, content per rack and service attach compound for years.
Bear, the stock already discounts a near-perfect supercycle. If hyperscaler spending slows, backlog slips, competitors press harder, or liquid cooling commoditizes, the multiple can compress sharply, even if the business itself stays perfectly healthy. Notice the asymmetry. Unlike a leveraged name, the debate here is almost entirely about valuation, not survival. The quality isn't really in question, the price is. Watch list, hyperscaler capital spending commentary. That's the master variable, the order and backlog trend, especially book-to-bill, liquid cooling share against Schneider and Eaton, and the margin trajectory as all that backlog converts. Those four will tell you whether the story is compounding or cooling.
Bottom line, Vertiv is arguably the highest quality way to own the AI power and cooling build. Best-in-class liquid cooling, a huge backlog, expanding margins, a clean balance sheet, and the NVIDIA stamp of approval. The honest debate isn't about the business, it's about price. It discounts a flawless supercycle, and it still rides on the hyperscalers' checkbooks. Understand both of those, and you understand Vertiv. That's the deep dive, educational only, not advice. Thanks for spending time with us, and we'll catch you on the next one.
And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity and a willingness to be wrong.
So if that's your kind of thing, stick around for the next one, and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.